maximizing after-tax investment income. And to start, first of all, I want to acknowledge Sarah and our newest member of the Ottawa branch, Philippe, who are organizing these webinars. I also want to recognize Frank Schilder, who's our Zoom master behind the scenes, who makes sure that it all works. Alan Corriveau, who is usually our host. And I also want to recognize Michael Patnode of the Ottawa Share Club, who puts together the excellent graphs that you will see. I want to go over our standard disclaimer that nothing in this presentation is advice or recommendation and is for information only. Underline that all investing involves risk. Readers should seek the advice of a registered financial investment advisor or conduct their own due diligence before making any investment decisions. And finally, I want to underline here that this webinar pertains to non-registered accounts. Now, what do I mean by a non-registered account? Well, let's talk about what is a registered account. A registered retirement savings plan, a registered retirement income fund, a registered education savings plan, or a tax-free savings account. All those are registered and don't have the same tax implications. So this webinar applies to taxable accounts, non-registered standard investment accounts. I'd like to start off today's session with a few words from our sponsor.
Let me tell you how it will be. There's one for you, 19 for me. 'Cause I'm a tax man. Yeah, I'm the tax man. Should 5% appear too small? Be thankful I don't take it all. 'Cause I'm the tax man. Yeah, I'm the tax man. If you drive a car, tax the street. If you try to fence, tax your feet. If you get to go, tax the heat. If you take a walk, I'll tax your feet. Tax man.
And thanks to Dave Gass for putting together that excellent video for us, which I think sets the tone perfectly of what we're going to talk about today. So one of the things I wanted to find out from you and like to start with is a poll question to understand a little bit better what your interests are in terms of your investment portfolio. So is your main interest capital gain? Is your main interest to generate Canadian dividends, income in general, or don't have a specific goal? Please go ahead and take a minute to vote. Okay, I think everyone's voted. Thank you, Frank. So it's good to know that people in general want income, and that is typical of our retirees. We normally have our investments to generate income so that we can pay for things like travel if we ever get to do it again, which not sure we will, but hopefully. Okay, so that helps me identify what my comment should be focused on. So let's understand the tax system to start. First of all, what are taxed at the highest marginal rate? What kinds of income? Well, first of all, interest. Any interest you get, like from a GIC or a bank account, a bond, is taxed at the highest marginal rate. Rental income, net rental income after expenses. Foreign dividends, any dividends from a company that is not a Canadian eligible dividend. And this surprises a lot of people. Any withdrawals from an RSP or RIF are taxed at the highest marginal tax rate. On the other hand, Canadian eligible dividends are taxed for the most part at the lowest rate. And you'll see how it depends on your taxable income level. By what are Canadian eligible dividends? Basically, they're dividends from any Canadian company that is registered and listed on the Toronto Stock Exchange. There are some exceptions, but for the most part. Capital gains are taxed at 50% of the marginal rate, what's called the inclusion rate. So if you have a capital gain of $100, only half of that is added to your taxable income for now. But the 50% inclusion rate is not a given. It's been as high as 75% in the past. And there's a lot of talk right now about the government having to look for ways to raise additional tax revenue, and capital gains tax is one of those things that is being talked about again. There's also something called return of capital, which you'll see on certain types of investments like real estate investment trusts, where essentially they're giving you back your own money. But there's no tax on that on an annual basis. You only pay tax on it when you sell the underlying security. So let's have a look to start at Ontario tax rates in 2021. And I think you'll find this very interesting. And I know a lot of people are surprised about this. But look at the line here, up to 49,000 taxable income. The tax rate on other income, which includes all those things I first mentioned, interest, rent, RIF, withdrawals, 24%. The tax rate on capital gains is half that because of the inclusion rate, 50%. But look what the tax rate is on Canadian dividends. It's actually negative. Now, I know a lot of people find this hard to believe, but in fact, the way it works is that the tax credit that you get is actually slightly more than the dividends. So you get slightly more back in a tax credit and you end up paying no tax. But even up to a taxable income of 79,000, the tax on Canadian dividends stays at a very low 6.5% compared to 29.5% for other income. And if you go through this chart all the way up to $98,000, the tax on dividends remains slightly lower. So you can see from here that by doing some tax planning, you can keep a lot more money in your pocket. The other thing that we'll get to a bit later is you'll see that the yield on dividends is considerably higher than the yield on interest at the moment. So you win twice. One, you get a much larger yield, and two, you pay much less tax. Now, I'm going to ask another poll question here, and it's really to be able to understand how to direct my comments compared to this chart in front of us. And if anyone feels concerned about answering this question, then either just select prefer not to answer or don't answer. But I want to assure you that all of the information here is going to be completely confidential. So asking about approximate personal taxable income. So less than 49,000, 49 to 79, more than 79, and prefer not to answer. Please go ahead. Okay, Frank, I think everyone's voted. So we can see that most of you, I guess a plurality, not a majority, 46% are in the more than 79,000 bracket. Quite a few are in the 49 to 79,000, and a few are in the less than 49,000. So this is good to know because, as you'll see, in both of these brackets, there can be significant advantages to certain types of income. So here's what I call the dividend sweet spot. Taxable income up to 49,000. And I see that it does not apply to an awful lot of folks, but just to remind folks that up to 49,000, the tax on Canadian qualified dividends is 0 or negative. So if you're in that income range, it's well worthwhile to ensure that you've got some good dividend income if you have a choice between different types of investments. And to give you an example, let's say that you've got other income of $40,000. You can have Canadian eligible dividend income of $6,500. So your taxable income goes up to $48,970, and your tax on the dividends is still -1. Now, the reason your taxable income goes up more than the 6,500 is because there's what's called the dividend gross up. And the way this works is a little complicated, but basically to calculate taxable income, they add 38% to the dividends. That goes on as taxable income prior to the tax credit, which comes on at the end of the whole tax calculation. So it's just something to be aware of. So in other words, you can't earn the full $9,000 worth of dividends and still not pay any tax. I hope that's clear. The other thing we need to talk about is the OAS clawback, the old age security payment clawback. The clawback begins at a taxable income of $79,845 in 2021. The $79,845 includes the 38% gross up on dividends. And so that goes in before the calculation of your total income and before the calculation of where the clawback starts. And the clawback adds 15% tax to all income sources until the OAS is fully clawed back. A lot of people don't get that and understand that it's essentially an additional tax. So for example, above 79,845, the effective tax rate on interest, RIF, and rental income is 46.5%, while the effective tax rate on dividends is 24%. And the OAS is fully clawed back this year at a taxable income of above $129,000. So to give you an example, in my own case, after I retired, I was doing some consulting work. And then I turned 65 and began to collect OAS. And I realized that my tax rate, marginal tax rate, went to 58%. At which point I said, I just don't see the point of working anymore. I'm not going to work and be paying the government more than I get. So here's how the OAS affects the effective tax rate. So if we look here, basically there's no effect until you get to the $79,000 range. And then once you're over that, you can see how the tax rate jumps from 30 to 46.5%, because there's other increases at the same time. And you can see how Canadian dividends stay much cheaper in terms of the tax rate. And that goes through the whole system up until about $98,000. But you can see here, if you're in that area earning above $79,000, how your tax rate jumps tremendously over that amount. And you can again see why getting your income in the form of capital gains or in terms of Canadian dividends makes sense.
Michael, sorry to interrupt you quickly. We just wanted to let everybody know that there's a slight technical issue with the number of participants who've been able to log in. And so we just want to say to everyone who's logged in, make sure to stay logged in or you won't be able to come back. So that's just that. We're working on it in the back. Thank you.
Okay, thank you. So we want to talk about some Canadian eligible dividend examples, and want to emphasize these are not recommendations, but just give you some examples of what Canadian dividends are yielding these days. So the top example is Enbridge. It's currently yielding about 8%. The current price is around $42. The 52-week high was 57, and the low was 32. The next one, TRP, is TC Energy, used to be TransCanada Pipelines. You can see the yield there, 6%. BCE is Bell Canada Enterprises, currently yielding 6%. And TD is, of course, TD Bank, currently yielding 4.4%. So you can see that these yields are way above what you get from, say, a GIC that's yielding 1.5%, or a 10-year Canada bond that's yielding under 1%. So here's an example of the total return over the last 5 years, comparing TC Energy and Enbridge, TC Energy being the orange line. And you can see that the total return, which includes dividends plus capital gain, over the last 5 years totals about 50%. So average of 10% per year, compound average would be closer to maybe 8.5%. Even Enbridge, which has not done nearly as well, has returned about roughly 4.5% per year, including the capital gains. And this chart compares BCE and Toronto Dominion Bank. Again, TD Bank has returned about 64% over 5 years, including dividends, and BCE has returned about 33%. So 33% is about 5.5% compounded, and 64% would be around 10% compound per year. I want to talk very briefly about preferred shares. They are a hybrid investment. They basically pay fixed yields, which are dividends, qualified dividends, for a specified period of time. So they're a bit like a bond that they pay a fixed amount for a specified period of time, but they pay dividends. They're currently yielding in the 4.5 to 5.5% range. The problem with them is that they are very illiquid and difficult to buy and sell. They don't trade a lot. There aren't a lot of them around. Companies really don't like issuing them because they're expensive for them. The only reason they do is because they count as equity. And so when companies need to raise equity, this is one way of doing it. But they're complicated and extremely challenging for retail investors. So they're best bought through ETFs, exchange traded funds, of which there are a few. But it's another way of getting qualified or eligible dividends. So I want to give you some examples of exchange traded funds that provide dividends. ZLB is a fund which is a what's called a minimum volatility equity fund, and it basically gives you exposure to Canadian equities, but hopefully at reduced risk. And you can see its return over 1 year was only 2%, because a lot of the big dividend paying companies did not do well over the past year. But you can see over 5 years, it's yielded a total about 10% per year, and the yield currently is 3%. XIC is a broad TSX ETF, covers everything in the TSX 250, and you can see the return over 5 years is 11% per year, currently yielding 3%. VDY is an ETF that focuses on dividends, big dividend payers. Again, you can see the 1 and 5 year return. The current yield is 4.4%. And again, you can see the management expense ratios here. One caveat about VDY, it is very heavily oriented towards banks and financial companies. So if you already own a lot of banks and financial companies, you probably would not be interested in VDY. HPR is a managed preferred share ETF. It's currently yielding about 6%, 5%, and you can see it's 6 and 4 year yields. Again, preferred shares have been beaten up a lot over the last few years. And finally, just as a comparison, VOO. VOO yielded, or was up 17% last year, average of 14% over the years. It only has a yield of 1.6%. But I throw this in because, as I mentioned, once you get over a certain income level, and I'll show you that in a minute, you may be better off focusing on capital gain rather than dividends because the tax rate is less. And finally, I put in here VBAL, which is one of these all-in-one ETFs, 60% stocks of the world, 40% bonds. You can see the 1-year return, 10%. It's only been around for 2 years, but it's averaged 11.5%. Yield is 2%. And I put this in because these are a great way to get a very diversified portfolio as a base, as a core that you can build around very quickly. And I just want to stop here for 1 sec and tell you about an article I read in the Wall Street Journal this week. And it goes to the whole issue of predicting what's going to happen in markets. And this writer wrote a hypothesis that, let's say in January, a year ago, you knew, and you were the only one who knew what was about to happen in the world with COVID and what happened to economies and the horrible health care and death issues that transpired. And if you knew that and you were for sure, what would you have done in terms of the stock market? Well, you probably would have sold almost everything, and you may have bought a lot of options to, short sell the market because you knew, of course, that things are going to be horrible. Well, things were horrible, but look what the markets did. The markets in the United States are up 17%, and the markets worldwide in a balanced portfolio are up 10%. So the basic point here is that even if you know what's going to happen, you still can't predict what's going to happen in the markets. Warren Buffett has a great line. He says, the only value of market forecasters is to make fortune tellers look good. So my point here is stop worrying about what the markets are going to do, because even if you knew what was going to happen in the future, it still doesn't tell you what the markets are going to do. So let's plan as if we don't know, we're never going to know, and we don't have to know. So I wanted just to show you here how some of these other investments worked over the last 4 or 5 years. And you can see the iShares Core S&P TSX compared to the BMO Low Volatility and the Vanguard High Yield ETF. And you can see that over that period of time, there isn't a huge amount of difference in how they performed over 5 years. It's about the same. Now, as I mentioned, higher income earners may prefer capital gains to dividends. And so if you look here, starting over about $93,000, over $98,000, the tax on capital gains is actually less than it is on dividends. Still much higher on other income, but there's a little bit of a benefit here in terms of the taxes for capital gains. So for the higher income earners over 98,000, having a mix of dividends and capital gains in your investment strategy makes sense. So here's poll question number 3. I've invested income in income producing real estate. Yes, and it's been a good investment. Yes, but I've lost money. No, but I would like to. And no, I'm not going to because I hate fixing broken toilets. Please go ahead and vote. Okay, Frank, I think everyone's voted. So 60% say no, they're not going to because they hate fixing broken toilets. And I agree with them completely. I hate it. Some 20% have had it as a good investment. Some have had it and lost money. Some say no, but they'd like to. And the reason I raise this question is because real estate can be a good investment for producing income, but there's ways to do it without fixing broken toilets. And the ways to do that are through real estate investment trusts. And real estate investment trusts can offer some important tax advantages. So what's a real estate investment trust? It's simply a company that owns property, for example, shopping centers, for example, retirement homes, perhaps neither of which are good investments these days, apartment buildings, industrial buildings, distribution centers, whole range of things. So here's a couple of REIT ETFs that each own 20 to 25 individual REITs. And the first one, RIT, is interesting because it's an actively managed ETF. It actually selects the companies it wants to invest in. And as a result, its return has been pretty good over the last 10 years. You can see here on the right, it's averaged a total return, including payments, yields of about 10% per year. And if you look at their ownership right now, they have virtually no REITs that own shopping centers, retirement homes, things like that. XRE is another REIT ETF, but it uses an index approach. It's not actively managed. So it may own whatever are the biggest companies in the REIT world because they simply own them by capitalization. And you can see that their return hasn't been quite as good. The trailing return on RIT is 4.9%. That means what you can expect in payments, distributions, and 4.5 on XRE. Now look at this though. On RIT, in the distributions last year, 65% came as capital gain. So when you get the T5 for these, you get a capital gain rather than other income, i.e. rental income. You also get some return of capital. So you pay, remember, no tax on that until you sell the underlying ETF. So for people wanting capital gain and liking the idea of owning some real estate, still want some income, this is an interesting way of doing it. So get to the end here fairly quickly. So our general strategic principles here, we want to optimize Canadian eligible dividends. We want to optimize capital gains. We want to avoid having to sell after a market correction. So we want income coming in. We want to maximize return of capital income because then we don't have to pay any income on it, any tax on it until we sell. Some tax tips I also wanted to throw in, since we're talking about taxes. One thing that you might consider is to donate appreciated investments to registered charities. And a lot of people aren't aware of this, but let's say you've got an investment that's doubled. If you give that to a charity as the actual security, don't sell it before you give it, then there's no tax on the capital gain. So you win two ways. You increase your donation, which increases your tax credit. The other thing is that most retirees should be maximizing their TFSA contributions. The total contribution room in 2021 is $75,500. You can put in $6,000 a year, but if you haven't filled up this contribution room, you can put money in right to the top of your available contribution room. And if you've got money in a taxable account, it should be moved into a TFSA. Over 60, I guess most of us are, but just to put this in, that TFSAs are probably a preferred way to invest than RSPs because of the way RSP withdrawals are taxed. Remember, they're fully taxed. And one final warning, US dividends in a TFSA are subject to a 15% withholding tax, and you don't get that back. So let's have poll question number 4. When withdrawing Canadian dividend income from a TFSA, the tax rate is same as Canadian eligible dividends, highest tax rate in a taxable account, or 0. Please vote now. Okay, well, I think everyone has voted, and the correct answer is 0. And I put this question in just to underline the fact that any money that you withdraw from a TFSA is tax-free. And that's the beauty of the TFSAs. So you can put your money in there, you can let it grow, but you can also have income from your TFSA of any sort, doesn't matter how that income is generated, and basically you pay no tax on it. And my favorite level of tax is no tax. So just to underline that point. So here's a model portfolio for income under 49,000. And these are just a suggestion. These are not recommendations, but give you an example of how you can do it. So in this case, I've put 40% into the VDY ETF. And by the way, these are all ETFs. 20% into the REIT ETF, 10% into the preferred, 30% into the balance. And you can see here that the average yield from that portfolio is 4%, and the average after-tax yield is 3.8%. So you pay a very small amount of tax. And this is a model portfolio for people with an income of around 79,000. It's very similar, but VDY again is 40, RIT 20, 10, and 30. Here, the average yield again is 4%. The after-tax yield's a little lower, but it's still pretty good at 3.6%. So you're only paying about 10% tax in this, which compared to what you pay on regular income is an awful lot better. I want to mention forthcoming webinars on February 17th, meeting your mandatory registered retirement income fund withdrawals, strategies to try to generate income to get close to those minimum withdrawals. March 3rd, how to invest in real estate. We'll talk a lot more about REITs. April 7th, how to inspire your kids and grandkids to be better investors than we were. There's so many better ways to invest today that just weren't there when we were younger. Makes me feel really envious. And then April 21st, 28th, May 5th, I'm going to reprise the Introduction to Investing for Retirees, 3 sessions, 3 consecutive weeks. And it's going to be very similar to what we did in September. How long ago was that? 2019, I guess, where we had up to 130 people personally in attendance. So if you know people who want to get a good basic understanding of investing, encourage them to attend this webinar. And finally, I want to stop